Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Zeta Global, ticker ZETA, and we're going to be exploring some really detailed sources that map out their corporate strategy and, well, what looks like an immense market opportunity.
It really is. Zeta Global is currently executing what the sources describe as a textbook SaaS transformation. They're shifting, and pretty dramatically, from being just a high-growth disruptor focused on, simple customer acquisition
Right.
to a highly predictable, high-margin Rule of 50 compounder. The whole focus now is on durability and some really stringent financial discipline.
And that right there sets the stage for the central conflict we need to explore in this deep dive. Because, while that operational transformation provides a rock-solid foundation, the company's potential for truly massive upside, analysts are suggesting a share price exceeding $30 per share, that hinges entirely on its success in winning a massive, almost generational enterprise replacement cycle.
A replacement cycle against some deeply entrenched legacy giants. We're talking about Salesforce and Adobe.
Exactly. This isn't just a battle for a little bit of market share. This is really a fight for the structural future of enterprise marketing technology.
That's it. And before we can even get into that competitive conflict, we have to establish the credibility of Zeta's execution. We just have to. Because if they can't deliver consistent results, then this whole thesis of competing against giants, well, it just falls apart.
Of course.
And the sources, they lay out an extraordinary track record of consistency, really since they went public back in 2021. They've exceeded their goals every single year.
And the number that really jumps out at me, the one that tells you they aren't just surviving but actually thriving, is this one.
Yeah.
16 quarters in a row of beating and raising guidance.
16.
That level of relentless, predictable execution in the software space is, it's exceedingly rare, especially coming off a multi-year period of just significant macroeconomic volatility.
Yeah, we have to pause and just contextualize those last 16 quarters for you. That period, it spans extreme supply chain disruption in 2021, the onset of severe inflation, aggressive Fed rate hikes through 22 and 23.
And global trade tensions, right? The tariffs running into 24 and 25.
All of it. So for a company that relies pretty heavily on enterprise ad spend to stay consistent through all of those cycles, it suggests their product offers true mission-critical value. It's not just some optional expenditure that gets cut during a downturn.
It speaks volumes to that durability component of the transformation they're executing. Their compound growth rate has just remained so robust. It's been consistently hovering in, the high 20s and low 30s, regardless of all that macro noise.
And that consistency really sets the stage for the latest reported performance, Q3 2025, which showed just impressive scale. The company reported $337 million in revenue.
Which was up a very healthy 26% year over year.
Yes. Now, 26% top-line growth is strong, but the real story, the thing that signals that maturity we've been talking about, is this shift in profitability. They hit a record Adjusted EBITDA of $78 million in that quarter.
And that pairing, that combination of aggressive growth with widening margins, that's the signature move, isn't it, of a company that's entering its compounding phase?
It is, and this is where we bring in the Rule of 40 metric, which is sort of the standard litmus test for software health. For anyone listening who might be newer to the metric, the Rule of 40 suggests that a healthy SaaS company's revenue growth rate plus its EBITDA margin, well, it should total 40 or more.
It's a quick way to measure the balance, right, between investing for growth and actually generating profits.
That's it, exactly.
So where does Zeta land on that scale?
Well, analysts are currently placing Zeta at the Rule of 47.
47.
Yeah, that's calculated based on their 26% top-line growth combined with that 21% EBITDA margin. Hitting 47 is significantly above the benchmark. It signals exceptional, durable momentum that balances that aggressive growth with increasing profitability.
And they're not stopping there.
No. In fact, the company explicitly stated in the source material that they are targeting becoming a Rule of 50 company by 2028. And this isn't just about hitting a target. It means achieving a structural margin profile that rivals the best in the industry while still maintaining that double-digit top-line expansion.
Okay, let's dive into the cash flow story, because this is where the durability case becomes truly compelling. It moves past, just a P&L accounting exercise and into the realm of real operational efficiency. Cash flow is the metric of a truly mature software firm.
It is, and Zeta seems determined to prove they belong in that club.
So what are the numbers?
In Q3 2025 alone, they generated $47 million in free cash flow, or FCF. That represents an 83% increase year over year.
An 83% increase. So that FCF generation is accelerating even faster than their revenue growth.
Right, which tells you their operations are becoming significantly more efficient at converting those sales into hard cash.
We hear FCF figures all the time, but what's the long-term implication here? Why should you care that they generated $47 million in FCF this quarter?
Because the management team isn't just focused on today's number, they are projecting a long-term free cash flow conversion rate of at least 70% from Adjusted EBITDA. And this is the crucial context point.
70%. Why is that such a massive signal of financial maturity?
Well, if we connect this to the bigger picture, that 70% conversion rate is typically achieved only by the largest, most entrenched, large-cap software firms. We're talking about companies that have optimized their infrastructure, minimized their capital expenditure, and have near-perfect control over their working capital cycles.
Whereas younger, fast-growth SaaS companies often struggle to convert maybe 20% or 30% of their EBITDA into FCF.
Exactly, because they're constantly investing so heavily in infrastructure or they're managing these complicated working capital requirements as they scale. Zeta is effectively signaling that they've achieved the financial discipline and operational efficiency of a decades-old industry leader.
So this isn't just some claim they're making. They have the historical data to back this up. Since their IPO in 2021, the company has increased its annual FCF generation by more than 8 times. It's been growing at a 70% compound annual growth rate.
And that CAGR, sustained over 5 years and spanning massive macroeconomic disruption, is really the definition of financial resilience.
It is.
It's a testament to the fact that their revenue streams are highly reliable and their cash collection cycles are robust. They've proven they can grow rapidly while self-funding their operations and, increasingly, their strategic M&A activities, which reduces their reliance on expensive external capital markets.
And you see the financial durability reflected directly in their customer base, which is, the engine of the whole operation. Their total scaled customers increased 20% year over year to 572 as of September 30, 2025. A healthy, steady expansion.
But if we focus specifically on their most valuable tier, what they call the super scaled customers, the growth there is even more impressive. That tier increased from 144 to 180 year over year. And these aren't just small pilots. These are clients generating substantial recurring revenue.
And the average revenue per user, the ARPU, for those super scaled customers is still very high, right?
It's still at $1.6 million annually. Very high.
So we have a company with a proven track record of execution, a strong Rule of 47 profile, and a commitment to FCF generation that puts them in the top tier of financial discipline. It sounds like a great business already, but that doesn't necessarily explain that $30 plus upside potential.
It doesn't. You're right. The financial metrics, they provide the rock-solid floor for the valuation. But to achieve that explosive ceiling, we have to turn our attention to the competitive dynamics that define their opportunity. This replacement cycle. The foundation is durable, but the potential is all competitive.
Okay, let's look at that competitive landscape then. The core thesis here revolves around a major market shift, a massive generational replacement cycle. What is driving enterprises to even consider ripping out technology they've spent, in some cases, hundreds of millions of dollars implementing?
Well, the primary competitive threat isn't a startup coming to disrupt the space. It's the profound dissatisfaction that enterprises have with the legacy marketing clouds. The guys like Salesforce, Oracle, and Adobe. And the sources are, well, they're absolutely scathing about the state of these legacy platforms.
They don't hold back.
Not at all. They're consistently described as bundled, overbuilt, chronically underused technology stacks, and often critically disconnected from the core identity data you need to execute modern marketing.
I love the bluntness of the CEO, David Steinberg, who referred to Salesforce's legacy marketing platform as the side hustle to the side hustle.
Yeah.
What that implies to me is just neglect.
It captures the feeling perfectly. It suggests that for these incumbents, marketing technology is often an afterthought, or it's a collection of disparate acquisitions that have been loosely duct-taped together. It's not a primary integrated focus. They may have massive distribution, but their infrastructure simply hasn't seen the investment needed to compete in the age of agentic AI and deterministic identity.
And that decay is what creates the vulnerability Zeta is exploiting.
Right. They're claiming to be the next generation unified marketing cloud.
Still, the motivation for enterprises to switch must be enormous. It has to overcome the cost and the pain of migration. So what's driving the urgency?
It boils down to two things: speed and financial justification. Modern enterprises, they need unified data and speed of execution to engage customers across all these different channels. They are not getting that from their legacy providers, and we're seeing a significant portion of requests for proposals, about 77% focused explicitly on unbundling clouds.
Because they realized they bought this expensive, oversized bundle when they only needed a few specific tools.
Exactly. And crucially, that focus on financial justification changes who holds the decision-making power. It's no longer just the chief marketing officer buying the latest shiny object.
The CFO is in the room now.
The CFO is in the room. They are now heavily involved, holding decision power in 79% of MarTech purchases. And when the CFO is in the room, the conversation just shifts entirely. Enterprises are no longer buying a technology bundle based on vendor prestige. They're buying a clear, measurable business case. They're buying ROI.
And Zeta's pitch, which seems to be proving highly compelling, directly addresses this CFO-level scrutiny. Their unified architecture reportedly offers 50% faster deployment.
And an astonishing 6x ROI.
Wow.
And when you combine the 50% faster deployment reduces implementation costs and time to value with that return, that 6x ROI, those kinds of metrics become irresistible to a financially savvy buyer. They are effectively telling the CFO, we can deploy faster, generate cash flow quicker, and provide a clear return that justifies the migration risk.
The acceleration of this replacement cycle is undeniable.
It is, and Zeta is positioned as the streamlined, financially justifiable alternative.
That acceleration leads us directly to the operational strategy they designed to capture all this wallet share, the OneZeta model. How does this strategy translate that replacement opportunity into the durable financial growth we were just talking about?
So the OneZeta model has evolved beyond just a sales motion, a way to package products, into a fully measurable operating model. It's designed to simplify expansion, reduce procurement friction, and ensure customers use the full breadth of the platform. It centers on increasing customer usage across 3 fundamental use cases: acquire new customers, retain existing ones, and grow their lifetime value.
This sounds a bit like a standard land and expand model, but the sources highlight a specific inflection point that makes this strategy particularly powerful.
It is the single biggest takeaway regarding the financial engine of this company. The economics behind OneZeta are all based on hitting a critical average revenue per user, or ARPU, inflection point. It happens when customers transition from utilizing one use case to 2 or more use cases. When they make that jump, they generate 3 times the average revenue per user.
3 times. Let's put some numbers around that for clarity.
Absolutely. We are talking about going from an average of $1.5 million annually per scaled customer to $4.5 million.
That's a huge jump.
Think of the operating leverage there. If Zeta successfully lands 100 new customers this year, but then only converts 15% of those accounts to be multi-use case customers, that 15% alone could potentially deliver as much revenue as the remaining 85% combined.
That's the leverage that makes this growth model so unique and incredibly efficient.
Right. The marginal cost of selling the second or third module to an existing, happy customer is minimal compared to acquiring a brand new customer entirely.
That 3x jump really makes the land and expand strategy financially turbocharged. But how big is the actual opportunity for cross-selling? Is the market already saturated with these multi-use case customers?
Not even close, which is why the runway is just immense. Over 80% of their current scaled customers use only one use case.
80%.
Yeah, that is a massive, addressable, installed base just ready for cross-selling and upselling. It provides durable growth visibility for years, irrespective of the need to find brand new logos.
That's resilience. They have massive built-in growth just by satisfying their existing customer base enough to sell them the next module.
Precisely. And the goal of the expansion playbook is to move past simply land, expand, and extend to what they call embed. Embedding the platform means establishing Zeta as the client's internal standard across multiple functions, replacing those legacy tools entirely.
And once they achieve that embedded status, their pricing power goes up, churn risk goes way down.
And it optimizes the unit economics. We're already seeing this multi-use case approach succeeding. The fastest growing customer cohort uses 4 or more channels, and that group already constitutes greater than 50% of the platform's overall revenue. The playbook is proven. Now it's just about executing it across the entire enterprise base.
Okay, but if the incumbent Salesforce, Adobe, if they're so overbuilt and underused, why haven't they fixed it? Is Zeta's ability to win this replacement cycle simply dependent on the incumbent's technological sloth? Or is there a truly fundamental protective technological difference that makes Zeta uniquely suited to win?
That's a critical question. And it brings us to their technological core. The incumbents can't simply fix it. Their fundamental architecture is often outdated and, more importantly, it's disconnected from a unified, durable identity layer. This is where Zeta's protective barrier, their technology moat, comes into play.
So the whole strategy is built on proprietary data and the agentic AI that runs on top of it. So if the financial execution is the foundation and the competitive conflict is the opportunity, then the technology moat is the competitive defense that allows them to win. Let's dive into those core technological defenses, starting with the data foundation, this proprietary asset they call the supergraph.
The supergraph is the deterministic foundation that sets Zeta apart. It serves as the ultimate competitive defense against both incumbents and emerging AI players. And deterministic data is the key here. It's not guessing who you are. It knows who you are based on verifiable permission identifiers.
Tell us what that means in practical terms. For you listening, what does that translate to?
So the supergraph covers over 245 million U.S. identities, essentially most U.S. adults. This massive pool of data is built on a large permission dataset, including identifiers like confirmed email addresses, postal addresses, connected devices. This is absolutely crucial for identity durability in a post-cookie web.
As third-party cookies crumble.
Right. As they crumble and regulatory requirements increase, probabilistic identity, which just tries to guess who you are based on your IP address and browser history, it becomes unreliable. Zeta's deterministic data gives them confidence in ground truth outcomes.
And the sources noted that the supergraph processes over 1 trillion signals, behavioral, location, propensity, affinity, intent signals, which are then used to inform their AI-powered experiences. That sheer volume of real-time behavioral data must be difficult, if not impossible, for a competitor to replicate.
That's the moat. The data asset meets 3 key criteria for long-term value. First, overwhelming size, scale, and durability. Second, active compliance and permissioning in an increasingly regulated environment. And third, possession of a seamless AI activation model. This proprietary dataset is their unfair advantage, and it feeds directly into their new layer of intelligence, Athena.
Athena. The critical new product layer, the agentic AI layer. It's described as contextual intelligence, built directly on top of the supergraph and their AI infrastructure. It's literally acting as a data scientist in a box. What's the strategic mission of Athena?
Its strategic mission is twofold. First, accelerate customer outcomes. And second, crucially, dramatically reduce the friction involved in switching from a legacy system. The goal of Athena is to make AI ubiquitous across the user experience, providing an interface standard that executives liken to a Bloomberg's dial command center.
A Bloomberg terminal for marketing. That sounds intimidating, but the concept is actually about simplicity, isn't it?
Precisely. The idea is that a marketer can simply ask in plain English, see the answer, and execute with approvals. You don't need to be a data science expert to utilize these complex models. Athena takes difficult analysis like recommending retargeting campaigns across 5 different channels or optimizing send times for a global audience, and it turns it into simple, actionable steps. It will literally show you the projected outcome, something like an increase in revenue by 5% before the action is even executed.
So it democratizes the power of their data and AI for non-technical users.
Yeah.
But how does it tackle the biggest barrier to this replacement cycle, the pain of switching?
This is where Athena becomes the secret weapon in that competitive conflict. As we noted, customer migration is the biggest barrier for potential clients moving off of those massive, complex behemoths of old marketing technology. The fear of vendor lock-in is real. You have years of scripting, custom code, unique workflows, all tied up in Salesforce or Adobe.
And that complexity, that fear of losing all that custom work, is exactly why CFOs hesitate to pull the trigger.
Athena directly attacks that hesitation. It uses AI agents that convert the coding language of other legacy platforms, like complex Salesforce scripting or legacy Adobe workflows, directly to the Zeta platform. This conversion process, which historically required months of expensive system integrator or SI work, is now seeing 80% faster onboarding.
Wait, let me just make sure I grasped the magnitude of that. An 80% reduction in onboarding time and cost? Because AI agents are converting legacy code. That doesn't just reduce friction, it fundamentally de-risks the entire migration process for the CFO. It turns a multi-million-dollar 12-month headache into a manageable 2-month operational project.
It addresses the biggest barrier head-on. Furthermore, Athena is driving serious staff productivity gains across non-technical roles like sales and marketing and even in product development through AI-assisted coding. It means the platform is both easier to adopt and cheaper to run, which further cements that 6x ROI pitch.
And the future vision for Athena suggests it's not just a marketing tool. Management suggested that through agentic workspaces and apps like retail diagnostics or a performance advisor, Athena could potentially become the client's full ERP, their full operating system, integrating marketing and business intelligence seamlessly.
If that happens, you move definitively from embed to essential. It would secure Zeta's position as a structural long-term partner across the entire enterprise. It also encourages us to think about their relationship with agencies and system integrators. They view agencies as partners, not competitors. Athena's design allows it to move laterally into their partner ecosystem, ensuring everyone uses the same standard, making tools connect instead of compete. They're building a platform that makes partners more productive, not obsolete.
That's a clever way to avoid alienating the SIs who traditionally make their money on those messy, slow migrations that Athena now streamlines. By making SIs 80% more efficient, Zeta encourages them to bring more clients onto the Zeta platform.
It's a network effect. It's designed to accelerate the replacement cycle and reduce channel conflict at the same time. They are building a technology stack that is easier to adopt, more effective to run, and supported by a unified data layer that is durable in the post-cookie world.
Okay, so if Zeta's technology moat and execution are strong, then the M&A strategy seems designed to accelerate their market penetration and financial targets. Zeta has a long history in M&A, right? I think the sources said 17 acquisitions over 17 years, but they operate with extremely strict criteria.
They do, and it tells you they are highly intentional about creating value, not just buying revenue. The sources highlighted 5 specific criteria for every single acquisition, which provide a useful filter for analyzing their deals.
And what are those 5 criteria?
Okay, first, they must fully integrate into the platform in less than a year. Second, they have to grow faster than the company's overall organic growth rate. Third, they must be accretive from day one, no loss leaders. Fourth, they need to possess clear synergies across the combined customer bases, meaning they can immediately cross-sell. And finally, they have to provide access to world-class human capital and relationships. These acquisitions aren't portfolio additions, they are structural accelerants for the platform and the OneZeta model.
Let's apply those criteria to the first recent acquisition, Live Intent, which closed in Q4 of 2024. What was the core rationale for that move?
Live Intent was described as a pioneer in people-based marketing and first-party identity solutions, and they're particularly strong in the mobile space. The rationale was simple: identity durability. This acquisition directly fortified Zeta's supergraph for the post-cookie landscape, adding proprietary technology and data assets that enhance their mobile-centric experiences.
So Live Intent was really a defensive, strategic acquisition. It was designed to make the core supergraph moat even stronger against changes in browser and mobile operating system tracking.
Exactly. It ensured that the deterministic data foundation remained intact, and it expanded their reach into high-value mobile inventory. The total purchase consideration was approximately $277 million, including cash, stock, and estimated earnouts. And the premium paid was really justified by the proprietary identity tech they brought into the fold.
All right, now we turn to the second, much larger and far more strategic acquisition, the Marigold enterprise software business. This includes Campaign Monitor Europe and Celligent Holdings. This is a massive play, expected to close by the end of 2025 for up to $325 million.
Marigold is the ultimate accelerant for the entire OneZeta strategy. The strategic upside is enormous, and it's immediate. It adds access to over 100 established global brands overnight. This includes more than 40 Fortune 500 companies and 20 of the 100 largest advertisers in North America.
So these are massive enterprise doors just opening up. Clients that Zeta historically would have spent years trying to acquire individually through that slow, complex RFP process.
This acquisition fast-forwards their enterprise penetration instantly. But the real magic, the financial leverage, lies in how those clients are currently using the Marigold platform.
You hit the nail on the head. The key strategic upside is tied directly back to that 3x ARPU inflection point we discussed earlier. Those 100-plus brands are currently utilizing Marigold primarily for just one use case: retain. mostly high-margin email software.
And Zeta's plan is to significantly triple the ARPU of those newly acquired customers by cross-selling the acquire and grow modules. It's instantly executing the core OneZeta expansion model into a new high-value captive customer base.
It's highly surgical. They're buying a stable, high-margin installed base specifically to execute their most lucrative financial playbook.
Yes. This isn't just about revenue addition, it's about structural acceleration of their entire Rule of 50 strategy. Furthermore, the acquisition provides a substantial margin tailwind. Marigold's business is extremely high-margin email software, and its historical cost of revenue profile is sub 30%.
And Zeta's blended costs of goods sold, their COGS, currently sits between 38% and 40%, bringing in a significant chunk of revenue that runs at a sub 30% COGS profile will structurally drive down the blended COGS for the entire company. It just pushes the overall adjusted EBITDA margin higher.
It ticks every single box in their M&A criteria. It adds high-value customers, expands them geographically, especially with Celigent in Europe, and significantly improves the overall unit economics and profitability profile of the combined business. Marigold accelerates the path to higher margins and significantly expands the available runway for that lucrative 3x ARPU jump.
This looks like a powerful combination of top-line growth acceleration and bottom-line margin expansion. It makes that Rule of 50 target seem very realistic. But it also introduces the necessary risk factor we have to explore: integration. Buying a software company is one thing. Successfully integrating a global enterprise software business into your core platform, especially one with a European presence and different regulatory considerations, that's an entirely different beast.
The risk is substantial, and we will absolutely return to that in our final verdict. But the strategy is clear. Use durable execution to build credibility, use the technology moat, Supergraph and Athena, to de-risk the competitive replacement cycle, and use strategic M&A like Marigold to accelerate the monetization playbook across a wider global installed base.
Okay, let's bring this all together now in our final verdict and look at the Zeta 2028 targets. The core investment case, as we've thoroughly laid out, rests on this assertion that Zeta's growth is durable, profitable, and predictable. And it's driven by proprietary data and that accelerating enterprise replacement cycle, particularly against the legacy giants.
And the management team, they published this Zeta 2028 plan, a detailed 3-year model. And it's important to note their claim that they are pacing ahead of this model currently. The goals are highly ambitious, but they're reflective of their confidence in winning that replacement cycle and integrating Marigold successfully.
What are those specific targets?
By 2028, they are targeting $2.1 billion in revenue. That represents a 20% compound annual growth rate from current levels. That kind of consistent double-digit growth, especially on a larger base post-Marigold, signals a lot of confidence in the longevity of the replacement opportunity.
And the profitability targets are just as compelling, reinforcing that transformation into a compounder, moving toward that Rule of 50 status.
Absolutely. They are targeting Adjusted EBITDA of $525 million by 2028, which is a 28% CGR. Even more structurally, their long-term goal is to achieve a structural Adjusted EBITDA margin of at least 30% by 2030. And that's driven by the positive mix shift from high-margin acquisitions like Marigold and increased productivity in sales and marketing, which is powered by their own AI, Athena.
That structural margin goal is a massive statement. I mean, achieving 30% structural margins in enterprise software puts you firmly in the category of a best-in-class financial performer.
And this brings us back to the market reality and the valuation assessment. Despite this track record of execution, the massive market opportunity, the Rule of 47 profile, and these clear targets, Zeta currently trades at a steep discount.
What does that discount look like numerically?
Zeta currently trades at approximately 3.3x forward sales. If you compare this to the established peer group, the large cap Rule of 40 plus software companies, they often trade in the 6x to 8x range.
That is a staggering disconnect. If they're executing flawlessly and analysts peg them in a Rule of 47, why is the market still penalizing them with a 3.3x multiple? What is the market fundamentally doubting about their story?
I think the market is fundamentally discounting two things. First, the market may still perceive Zeta as that disruptor focused on customer acquisition, not the predictable Rule of 50 compounder it is becoming. Old perceptions die hard, and it takes sustained execution for years to convince institutional investors of a paradigm shift.
And the second thing?
Second, and more critically, the market is discounting the successful execution of the replacement cycle against those entrenched giants and all the associated integration risks that come with it.
That discount suggests, for some analysts, that there is asymmetric upside potential through 2028. If the stock were to simply trade at the lower end of that peer range, say 6x forward sales instead of 3.3x, you're looking at virtually a 100% upside just from a re-rating, assuming they hit their targets.
It tells you how steep the current discount is. However, we have to provide a balanced risk assessment. Asymmetric upside comes with inherent risks, and we can't overlook the integration complexity, especially with Marigold. The 10Q explicitly outline these risks, and they need careful consideration.
Right, the cautionary note goes beyond just boilerplate risk factors. We need to be specific about the potential operational failure points here.
Exactly. The key risks center on the Marigold integration. While Zeta has a strong M&A history, the scale and geographic spread of this deal are new. Integration risks include difficulties in successfully merging complex technologies and operations, especially Selligent in Europe, where regulatory and cultural differences add layers of complexity. There is a serious risk of potential loss of key employees and high-value customer accounts if the integration isn't flawless, particularly from the acquired European entity.
And the distraction risk is also real. The diversion of senior management's attention to integrating a $325 million acquisition could slow down the execution of the core OneZeta expansion playbook across their existing 572 scaled customers. They need to manage this massive undertaking of Marigold while simultaneously converting those 80% of existing customers who are only using one use case.
The investment thesis is predicated on execution against established goals and successful, disciplined integration. If they manage to maintain that rule of 4750 execution while flawlessly onboarding Marigold, the market discount of 3.3x sales versus the 6 to 8x peer average will compress, and that $30 plus share price scenario becomes increasingly likely. But failure to integrate the global operations, or a distraction that leads to a missed quarter, would immediately jeopardize that thesis.
So the company is built on a foundation of operational discipline. Their competitive position is strengthened by a unique technology moat, the SuperGraph and Athena, and their growth is turbocharged by the OneZeta model and the Marigold acquisition. It's an incredibly high-leverage business model.
It is. The outcome of the next few years depends less on the macro environment, which they've historically navigated well, and more on their ability to manage hypergrowth and complex integration while competing against the established distribution networks of Salesforce and Adobe.
This brings us to a final provocative thought for you to consider as you reflect on this deep dive and the structural advantage Zeta claims to possess. Zeta's CEO, David Steinberg, made a fascinating long-term prediction about the competitive landscape of AI.
He did. He suggested that within 5 to 7 years, artificial intelligence algorithms and large language models will become ubiquitous. They'll become a commodity. Think of it like the automotive industry. Everyone uses similar steel, similar engine architectures, similar robotics. You end up with 4 or 5 dominant car companies, but the underlying technology becomes standardized.
And if the algorithms, the brains of the operation become commoditized, the source material argues that the only meaningful differentiator in the market will be the proprietary deterministic data you feed into it.
That's the crux of the long-term competitive moat. If the market is flooded with competing AI and ABARC solutions, all running similar, readily available LLMs, then the SuperGraph, covering 245 million identities and processing 1 trillion signals in a highly compliant, deterministic way, is not just a feature, it's the core strategic asset.
So if that premise holds true, that data trumps the algorithm in the long run, then Zeta is banking on the idea that they are selling the irreplaceable resource, the SuperGraph, through a highly efficient but commoditizing interface, which is Athena.
And the ultimate question then becomes, can the giants, who have immense resources, replicate that deterministic data moat before Zeta successfully leverages its current advantage, the friction removal agents of Athena, to embed itself irreversibly into the operations of those 100-plus Marigold enterprises and the hundreds of existing single-use customers?
That's the strategic battleground, defined by data scarcity and speed of execution. The clock is ticking, and the current valuation suggests the market still doubts the outcome. A compelling note to end on. Thank you for diving deep into the sources with us today.